gold prices continue to move higher, have continued to move higher as the Fed has resumed the easing cycle. And we had a very prominent Wall Street analyst recently amend his recommendations or make the recommendation for investors to move from a 60-40 equity fixed income model to a 60-20-20 split, equities, fixed income, and gold, using gold as an inflation hedge. It is a bit curious that this particular analyst and some other analysts have been increasing calls recently for investors to move into gold after gold has already rallied so much, not just recently, but over the long haul. Here we're looking at changes in commodity prices as well as in stock prices, fixed income, and home prices going back to the end of the 1990s. So since the end of the 1990s, the 2000s, the 2010s, and so far in the 2020s, what have stock prices done cumulatively? Fixed income prices, home prices, and also the commodity complex over that time period of a little bit more than 25 years. You can see that going back to the 1990s, the end of the 1990s, so December 31st of 1999 until today, gold prices have dominated not just other commodity prices, but they've dominated stock prices, they've dominated fixed income, and they've dominated home prices as well. Gold is up by over 1,200% since the end of the 1990s. Stocks, S&P 500 at least, up by a little bit less than 630%. Fixed income, as measured by the Bloomberg Ag, up by a little bit less than 180%, and home prices, as proxied by the Case-Shiller Index, up by a little bit more than 230%. And again, these are cumulative numbers over a period of a little bit more than 25 years. So it's been quite a run for gold prices. And admittedly, whenever you put together a chart like this or an analysis like this, your starting point very much matters. So we should acknowledge that here. At the end of the 1990s, as we just alluded to with the prior chart, the equity market was coming towards the end of an historic run, and we had a big bear market in front of us, not only the bear market from 2000 to 2002, but we relatively shortly thereafter fell into a bear market in 2007 that was long and deep as well. Had another bear market, of course, in 2020, and then another one in 2022. So the starting point for stocks was not great. The starting point for commodities was pretty good. Commodities were weak for the most part in the late 1990s, so a good launching point. But even still, you see how much gold has outperformed all other commodities, and outside of cocoa, copper, and silver, outperformed to a substantial degree other commodities, even though many of these individual commodities were also weak in the late 1990s. So a very curious time to be advocating for a move into gold after a structural run of this nature. Commodities historically move in long-term super cycles. They're not cyclical in the same way that equities are cyclical, fixed income is cyclical, or home prices are cyclical. They tend to be super cyclical. And we've had, especially for gold, a very strong super cycle. So we would advocate caution for those, especially looking out over the next 10, 20, 25 years, those who might be thinking about moving into an area that already has done quite well over the long haul.
To watch this month's complete analysis and receive daily updates directly to your inbox, become a member at cycleframework.com.